del FOM de marzo. Nosotros, para hablar de todo esto y mucho más, damos ya la bienvenida a nuestro invitado internacional, Henry Smith, Investment Strategist in Multi-Asset Solution at AllianceBernstein. How are you, Henry?
I'm very good, thank you. How are you doing?
Fine, thank you. I want to start by talking about the current outlook. What do you think at AllianceBernstein right now about the economy and the markets?
Sure. So I guess despite some sort of blips, and while our outlook is generally still cautious, our economic outlook has improved compared to what it was at the end of 2022. And this primarily reflects a few factors, but namely China's rapid reopening earlier this year, the normalization of excess goods inventories, and still strong labor markets, which, all of these factors are kind of pointing to improving growth prospects. And I guess, by extension of that, specifically within Europe, we've seen a milder winter and a sharp decline in natural gas prices, which was one of the major concerns of downside economic risk going into this year. And so to sort of summarize all of that, really, where we are today is a base case of a mild recession in most regions, with a considerably brighter outlook going into year end. And I think just to sort of reflect on some of the data points that sort of corroborate or sort of share that view, if we look towards forward-looking global economic activity indicators, such as purchasing manager indexes, these currently show pretty broad-based improvements in economic activity, and they show economic activity having bottomed in the final quarter of 2022, and they are now indicating that the global economy is moving from a sort of contraction or recession towards a recovery in growth. And we think that this will be welcome news for corporate profitability. So despite strong revenue growth in the last few quarters, corporate profits have come under pressure by supply chain challenges and by increases in the cost of inputs. And so going forward, given that growth outlook, we expect a reversal to begin with profit growth starting to recover, with supply chain pressures fading, and as prices start to catch up with input costs. Now, the persistence of elevated inflation, and hence where terminal rates for central bank interest rates will land, this has been a key driver of market volatility over the last year or so. And given that there is a lag between when central banks take action and this starting to take effect within the global economy, we believe that we are now approaching a point where the rate hiking cycle is reaching its completion. And so we think the debate for market participants will shift from where will rates land to how long will rates be held still or pause, and if any, will there be any rate cuts, and when will they occur?
Henry, I would like to ask you also, in this outlook with improvement in corporate profits for growth, is the banking sector stress going to affect? Can we see another case like Credit Suisse or Silicon Valley Bank or Signature Bank?
Sure. So, the short answer to your question there is yes, the recent banking sector stresses are a very important consideration. That outlook that I just described is underpinned by a view that the recent banking turmoil does not spiral into a broader financial contagion. But I think it's important to highlight that while these stresses in the banking sector exposed some of the risks of rapidly raising interest rates, we believe that regulators have taken appropriate steps to prevent that broader financial contagion. And so, to be clear, our base case is that the turmoil won't develop into a full-blown crisis like we saw in, say, 2007, 2008. And we think that, that 2008 banking crisis is a useful comparison. And I think it's important for people to remember that, there are some stark differences this time around. This time, the overall banking system remains well capitalized. And thanks to that very decisive and quick regulatory action we saw in recent weeks, this crisis has so far been contained mostly to a few financial institutions, all of which have their own unique circumstances. Now, that said, I don't want to completely dismiss this as a risk. As our economists at AB have been very keen to reiterate, the financial sector is where problems go to become big crises. And so any investor that ignores the possibility that this could worsen is disregarding one of economic history's big lessons, which is when central banks raise rates, things will break. And so at this stage, it's too early to fully dismiss this risk, but we take comfort in what we've seen so far, and we think that this is something that needs to be monitored very closely.
And Henry, talking about these interest rates increasing, that was the first problem that with Silicon Valley Bank, with the assets of Silicon Valley Bank. Do you think the Fed is done right now by raising rates?
Sure. So I guess, when it comes to the broader impact of what's happened recently with Silicon Valley Bank and other distressed banks, if we set aside those sort of losses that investors faced from their investments in those banks, one of the biggest impacts that we've seen has been a rapid repricing of market interest rate expectations. And so expectations today have fallen well below 2022 year-end levels, and they have more than reversed the rise in expectations that we saw in February on the heels of better than expected growth and inflation data. So it's important to note that these lower interest rate expectations, I'm not just talking about any one particular economy. This is pretty broad-based across many major economies. And what is quite interesting is these rate expectations are now beginning to reprice in the expectations of rate cuts within the next 12 months, particularly within the US, which is priced sooner than in other markets. So from our perspective, even if the most recent banking stresses are contained, and this is the end of the sort of financial challenges for the banking sector, we believe that this episode has served to remind market participants and policymakers of the risks of rapidly raising interest rates. And by extension, and I guess in addition to this, there is now concern that we'll see depressed credit growth going forward, which may in turn tighten financial conditions without the need for any further interest rate rises from central banks. So as a result, and sort of all else equal, this reinforces our belief that we may now be very close to peak policy rates.
Very interesting, Henry. And finally, how does this affect to your asset class positioning going forward?
Sure. So when we look at asset class positioning, we take into account both a fundamental assessment, but we also integrate a broad consideration of a spectrum of different quantitative signals, from price momentum to risk premia, in making our asset allocation decisions. And we also believe it's important not to overlook significant market events either, taking into account, say, the recent banking stresses, even if they're driven more by fear than fundamental factors. But having sort of said that and sort of setting the scene, where we are today in terms of our asset class positioning, when we weigh all of these inputs, both fundamental and quantitative, we've marginally reduced our exposure to equities as an asset class in the last few months. And today we remain underweight and relatively cautious in this current environment. Within those equity allocations, we are also modestly overweight to emerging markets. That's reflecting the sort of recent economic growth pickup that we expect within the region compared to developed markets. And additionally, we've also moved from slightly underweight to US equities to moderately overweight. And that reflects the defensive characteristics of the US. And it also reflects a desire for a lower exposure to financials and commodity-sensitive companies as a precaution of what we're seeing today. Beyond equities, if we look at fixed income, we've also increased our underweight to duration, which is effectively interest rate risk within the portfolio so far this year. And that positioning change reflects stronger than expected jobs data, stronger economic growth resilience, as well as some of the upward revisions we've seen to inflation trajectories. And when we look broadly across the market, we believe that the market is generally underweight to bonds at the moment. And we believe that this reflects more market technical signals and poor sort of investor sentiment for the asset class, rather than issuer fundamentals, which we think remain strong. And I guess on the point of issuer fundamentals, we are slightly overweight to corporate credit. But we have been making some small reductions to that positioning within recent weeks. From our perspectives, if bank regulators' efforts are successful, we'll likely start to add back to this positioning, while carefully gauging the residual impact of the recent banking events on firms' ability to borrow money, especially for smaller or highly leveraged firms. But to sort of wrap up, just in terms of positioning, I would sort of just reiterate that while the recent bank failures point, whether those prove to be a flash in the pan or whether those prove to be something more lasting, we believe that multi-asset strategies are unique in their ability to respond and to adapt. We believe that the case for a diversified investment strategy that can respond to evolving challenges, evolving opportunities, remains stronger than ever.
So very interesting, these multi-asset solutions. Henry Smith, thank you for your time. He's an investment strategist in multi-asset solution at AllianceBernstein. Have a nice evening.
Thank you. It's been a pleasure.